I'm fresh back from the Woodstock of Capitalism, Omaha, Nebraska, over the weekend for the big Berkshire Hathaway event with Warren Buffett and Charlie Munger holding court over about 40,000 investors. It was an enjoyable experience, as always, of course, supporting my new shirt here, and got to get my new ducks in the fold so they can join the others on the shelf behind me. But really enjoyed hearing from a couple of the masters over the weekend, their thoughts on the economy, whether we're heading into a recession, what they think about inflation, how the regional banks are starting to impact their philosophy and their thoughts. And of course, that works its way into our own conversations in these videos, where the Russell 2000 is still struggling compared to the NASDAQ because of that regional bank exposure. We'll talk about that tonight. We'll take another deep dive into the sector analysis. I want to show you how the mega cap tech stocks are really outperforming the average tech stock out there. And then we're going to get into our trade application example, where I wanted to focus on an energy stock that's stuck smack dab in the middle of its 3-month range. And we're going to do an iron condor on that. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 9th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see from our S&P 500 heat map here, it looks like we had quite a bit more selling than buying here today. We had a few smatterings of green here and there, but it really wasn't very consistent. One that stands out to me is McKesson right here, was up about 5.5%. We also saw that DaVita was up 12%. So those two healthcare companies certainly stole the show here today. We also saw a number of industrials companies closing a bit higher. Boeing had a pretty nice day there, which was up 2%. We also had TransDigm up 4.68%, and Raytheon up about 1% there. So seemed like we had a little bit more buying in the industrial sector than we saw in some of the other areas. We also saw a little bit of buying up here in the consumer discretionary area. Home Depot was up about 1%. Lowe's is up about 1.5%. I see that Marriott was up about 0.5%. I stayed at a lot of hotels in the last 5 days. One of them, I believe, was a Marriott. So, but they are all still asking a pretty penny for just a one-night stay in many cases. For those of you that have done any traveling, I'm sure you understand there. And I did notice that Wynn Resorts came out with earnings here earlier this evening in the after hours session, and their stock was up nicely after hours. However, on the opposite side of that conversation, we did see that Airbnb's stock was down in the after hours session here tonight. So the hotel and travel theme has been an interesting one recently, but I can tell you that Marriott and Booking.com and some of those other hotel and travel related names, resorts companies, that sort of thing, have been doing reasonably well compared to many other patterns that I've been seeing out there. In the financial space, we had a little bit more of a hit and miss situation. It wasn't a one-sided sell-off the way that we have been accustomed to, especially with the banks. But today we did find a little bit of green out there. Many of the insurance companies were green today. Of course, just getting back from my Berkshire Hathaway trip, and although Berkshire is technically considered a conglomerate, they do have to put it in a sector somewhere, and that happens to be in the financial sector because a big chunk of what they do from an operational business perspective is still in the insurance industry with Geico and General Re and a number of those internal holdings there. So a lot of insurance companies seem to do pretty well today. Progressive was up 1.2%. We also have Chubb up about 1%, Allstate up about 2%, Travelers was up about 0.65%. And as I was going through various charts here this afternoon before the market closed looking for trade ideas, I will say that a couple of those did catch my eye. I didn't end up going with them in the end, but I will say that I did consider bullish trade ideas on Chubb and Travelers. Their charts are setting up somewhat nicely with bounces here recently. So remember, the financials are more than just the banks. The banks kind of get all of the notoriety, but there are other areas within financials, and some of those other areas seem to be stabilizing a little bit better here recently. Otherwise, it was a pretty, bearish day, all things considered. It wasn't a massive sell-off by any means, so I don't want to make too much of it. But without a doubt, there's a lot more red on our screen here than green. And of course, a lot of the tech stocks have been in focus here lately, with Apple having a phenomenal day last week and, making Warren Buffett quite happy in that regard after they reported their earnings. Today, not so much. They were down about 1% here today. Microsoft down about 0.5%. Nvidia down about 2% today, so a little bit more pressure out of that one there. Let's go ahead and take a look here now at what our actual breadth numbers were. So let's come over to the main part of the platform and pull up our heat map and then switch that to index watch. Sorry, I usually have this set up ahead of time. I'm running behind here tonight. For those of you that are premium members, you probably just got an email from me here not too long ago saying that I did another DGI class after the bell here tonight, so I had to quickly get that done before doing the market outlook video. So my apologies for getting this out a little bit later than I normally do, but we kind of have a change taking place here at Market Scholars, where we've been on WebEx for many, many years, 5 years plus. Plus, of course, the time we were on WebEx when we worked for TD Ameritrade prior to that. But we've officially switched to Zoom, and so we'll see how that goes. But anyway, we had some last-minute rearranging to do this morning, so it kind of affected our typical schedule. So thanks for bearing with us on that. Anyway, in order to set this up, what I usually show you guys here, I just come up to the top, go to Market Watch, and then switch this visualization from heat map to index watch, and then change this watch list right here to go down to the public watch list and the S&P 500. And once I've done that, you can see here 178 advancers and 319 decliners. So get my calculator out here real quick, and it looks like that was it was close to a third to two-thirds split here today. 35% of the market managed to close in the green, and about 65% there in the red. So clearly a day that was tilted a little bit more bearishly today. Not a huge deal, but nonetheless did kind of back up the reason why the S&P 500 was down about 0.5% here today. So let's now take a look here at our foregrid. And you can see that we do have a bearish posture on our two charts up at the top now. And so that is the S&P 500 in the top left and the Dow Jones in the top right. And again, I've been away on my road trip here as I took my son and my wife to the Berkshire Hathaway meeting as well. So we made a family road trip out of it. So I've been a little bit out of unplugged from the markets. You'll have to forgive me there. I've been trying to keep my eye on prices and things like that from my iPhone and my apps and different things like that. But it's not quite the same thing as actually watching the data right before your eyes all day long like I typically am when I'm in my home office. But as you can see here, for the last 2 or 3 days, we've actually been in this pink zone for the S&P 500 and for the Dow Jones. So while we are trading above the rising moving average on the S&P 500, there's been enough wear and tear on this selling, particularly this 4-day pullback that we had right here, that switched that green background to that pink background. So we went from having a strongly bullish intermediate posture to now having a weakly bearish intermediate posture. You can see that occurred when that green line fell out of the upper reversal zone and started traveling lower between 80 and 20, and that happened exactly on that day right there where the color transition took place on the chart. This is chart 4B, by the way, for those of you following along at home. Of course, we give access to all of our charts to our premium members. We actually got a question about this via email over the weekend as well. So I try to bring this up nearly every time I conduct this video, but sometimes people miss me saying that, or maybe they're not hearing it at that time or what have you. But if you hear me repeating myself a lot, it's because we get emails like that, so we have to kind of react to that. So just a reminder that if you wanted access to all 50 plus of our customized charts that we put together using ThinkScript on the Thinkorswim platform, you would get access to that as a 3-year premium member of Market Scholars. So another incentive there if you were thinking about joining our fledgling business here. Anyway, back over here to the chart, you can see the S&P 500 was down 0.46% today. It continues to have a weekly bearish intermediate posture. However, it does remain currently above its rising moving average. So a little bit of conflicting signals there to a degree. With the Dow Jones, it was down 0.17% today, so a smaller pullback. And remember, that is typically the case whenever we have a big up or a big down day. The Dow Jones usually has a muted response compared to the other areas. So today the Dow was the leader when the markets sold off because it was down the least amount, because it has kind of your big blue chip companies that tend not to move around as aggressively as more speculative investments. But remember, the flip side is also true. Oftentimes when we have a up day in the market, the Dow is lagging that day because it doesn't keep up with the speculative one. So you kind of have to take the good with the bad from that regard. But it kind of fell in line with our traditional thinking here today, with it being down the least amount of these four, barely pulling back at all. Nonetheless, does retain that weekly bearish posture, and its moving average and where its price is currently is basically neck and neck. According to what we see here in the color of the moving average, which is now yellow, and I can see with my eye it's still rising, we must have closed just a couple of pennies below the actual moving average here today. But it is really close. It could have easily been the opposite and closed just a hair above the moving average. I'm thinking it's probably just within a couple of pennies there. So it could easily go back to a green moving average as soon as tomorrow if the market is up tomorrow. Onto the two charts on the bottom now, you can see that the NASDAQ yesterday, in hitting that new 3-month high, does have that dark green background color, telling us that we have a strongly bullish posture on the intermediate line for the market forecast. It is the only one of these 4 charts that can make that claim. You'll see here in just a moment when we talk about the Russell 2000, it has a green background, but it's that light green color. So we would call that weakly bullish. The NASDAQ is strongly bullish. And the difference between the two charts at the bottom should be pretty stark, right? The NASDAQ looks a lot stronger, just eyeballing it to most people that are comfortable looking at charts, whereas the Russell 2000 is just attempting not to go to lower lows. The NASDAQ is literally going to 3-month highs, or at least it did yesterday. Again, a little bit of a pullback here today. It was our worst performer, and again, similar to the conversation about the Dow, that's fairly typical. Usually when you have an up day, the NASDAQ has a decent chance of being the leader because it's filled with more speculative stocks. However, when we have a down day in the market, the NASDAQ has a better chance to be the laggard because of those speculative stocks. So they just move around a little bit more aggressively. So it wasn't a big deal. It wasn't even a 1% pullback. So basically a yawn of a day for most of these indices. NASDAQ down 0.63%, not enough to take away the strongly bullish posture. You can see we're still above a rising moving average there. That 30-day moving average is green. Also down below, you'll notice right here that this red line is in the lower reversal zone at a time that we have a strongly bullish posture on the NASDAQ. The combination of those two things would tell us that we have a bullish intermediate confirmation signal. However, like you've heard us mention in the past, there are better signals and worse signals. So they all exist, but there are ways to kind of try to determine whether the signals are, worth a little bit more consideration in taking. And in this case, unfortunately, this would not be considered an ideal signal for two different reasons. The red line, as you can see, is below 20, which is what is required in order to have that signal. However, we don't like it to go below 5, so we're being a little picky there, but our preference would be to have the red line be somewhere between 5 and 20 on those bullish intermediate confirmation signals. Here you can see the red line ended today at 1.62. You can read that in that red label right there. So clearly that's below 5.0. That tells us that there's a little bit more of an extreme reading there, and it's less trustworthy as a result. The other thing to be aware of is that the blue line is not technically part of the bullish intermediate confirmation signal, but we've noticed in the past that the better signals that exist out there have the blue line somewhere between 50 and 20. And here it's not even close. It's way up there at 77. So it kind of fails those two tertiary considerations there, even though technically there is a bullish intermediate confirmation signal. The Russell 2000 also has one. Now keep in mind the Russell 2000 only has a weekly bullish posture, not a strongly bullish one. However, that still could qualify for a bullish intermediate confirmation signal. In this case, notice that the red line is in a more pleasant location at 18, so that's nicely between that 5 and 20 that I mentioned before. However, you still have the same problem with the blue line. It is not housed between 20 and 50. It's slightly above 50 at 58. So neither one of those would be considered kind of, stop what you're doing and pay attention to this signal type of a moment. It doesn't mean that they can't work. It just means that the setups are less than ideal in these cases. However, they do exist, so feel free to notate that on your own as well. Of the two, as I mentioned before, it's clear that the Nasdaq's chart looks a lot stronger than the Russell 2000. The Russell 2000 is just basically trying to stabilize, and it did not go down as much as what we saw with, let's say, the S&P 500 and the Dow Jones during that 4-day pullback there, right? A couple of those days, you actually saw the Russell 2000 closing up. I think that was a slightly up day, that was a slightly up day, and then 2 down days there. Whereas those 2 up there, the Dow and the S&P 500, those were 4 straight down days. So that's why you are able to have the Russell 2000 come back with a weekly bullish posture a little bit sooner than those two. Doesn't mean that the charts look better, because I would contend that they don't. I still think that all of the other 3 charts look better, but you also have to recognize that trends do eventually change. Stocks don't go down forever, just like they don't go up forever. And if we do eventually have a trend change, then we want to be able to kind of pick up on some of these, smaller clues. And maybe, just maybe, this is the start of some resilience out of the Russell 2000. Remember what we've talked about for quite some time now. If you want the Russell 2000 to start outperforming, you're effectively asking for the banking crisis to be over, because what has basically held the Russell 2000 back, from my opinion, is that the regional banks have really thrown a cold blanket on any potential advance out of the smaller companies out there, whereas there are no regional banks in the Dow Jones Industrial Average, is just one example. So if we get some sort of a push higher out of the regional banks, then maybe we can have that conversation about the Russell 2000 starting to lead again. Until then, I'm going to remain a little bit skeptical. Of course, we've got a lot of things going on: CPI, PPI. We've got a government, debt ceiling issue that we're grappling with. We're still going through earnings season. Who knows what happens with FDIC insurance, and what will happen with PacWest Bank and some of the other regionals that start to look a little wobbly all of a sudden again. So there's a lot of things going on right now. But the Russell 2000, from my opinion, is not going to have a major outperforming opportunity until the regional banks start to bounce from the levels that they're at right now. But at least you've got a weekly bullish posture. You got to start somewhere, and that green line is rising between 20 and 80. It's at 41. Remember, it would have to get above 50 for that background color to turn dark green. So We're a little ways away from doing that, but hey, one or two big up days out of the Russell 2000 and we could be having that conversation. And ideally that would bring you up above that moving average at the same time. Right now you're still below a falling moving average. That's not a very good look for an index, right? You want it to be able to get above the moving average like it did back over here in mid-April, but then as importantly, hold those levels. And that's what it has failed to do up until this point. It has rolled over every time it's attempted to retake that 30-day moving average. And right now we're still in that mediocre, kind of weaker position there, regardless of what the posture is. So hopefully one of these days we can push above there and stay above there. But we can't assume that that's going to happen in the short term. It could very well just be the resistance area that we're dealing with, and maybe later this summer we won't be above the moving average, right? There's a lot of things that could happen between now and then, but right now, path of least resistance does continue to be to the downside according to the moving average itself. Let's take a look now at the 3 green arrow status, and this will be chart 4D for those of you following along at home. And at this moment, we'd have just one of the charts with a 3 green arrow status. No surprise, it is the NASDAQ composite. Remember, that was the one that stood out on the last set of 4 grids. That was the only one that had a strongly bullish posture. So no surprise that it's the only one in this case that also has a 3 green arrow status, where you've got a green arrow on the moving average, green arrow on the MACD histogram, and a green arrow down below, which you can barely see. So let me scoot that up. On the stochastic down below here with this move that it had to new multi-month highs yesterday. So no surprise, this is the leading index at the moment. You could probably say that the S&P 500 is the second leading index because it hit a multi-month high here just on May 1st. Whereas if you look at the Dow, you'd have to go all the way back here to February 14th. So you've got a little bit more overhead resistance there on the Dow, and we've broken through that to a degree on the S&P 500 and the NASDAQ composite. Of course, the Russell 2000 remains our laggard here, as it is still trading closer to 3-month lows than it is trading to 3-month highs. So it's trying to rebound, but it's got work to do in that regard. So NASDAQ clearly our leader, Russell 2000 clearly our laggard at this moment. By the way, none of these charts have 3 red arrows. Yesterday, the Russell 2000 did, but today it was able to get a green arrow back on the MACD histogram. So 3 of our charts have mixed green and red arrows. One of our charts, the NASDAQ composite, does have an official 3 green arrow signal at this moment. Let's take a look at what's going on from a longer term perspective now with the 1040 crossover method. And you can see here that 3 out of our 4 charts do have what's known as a golden cross, which of course is a bullish feature. A reminder that when we're looking at this chart 4C, we're looking at 3 years worth of data for each of the charts, and each one of the candles is 1 week in time. And what we're looking at with the orange line is the 10-week moving average, and the blue line is the 40-week moving average. And you can see here, it was about a month ago that on the S&P 500, the orange line went up and over the blue line and has maintained that for the last month. Same thing happened over here on the Dow. Same thing happened down below here on the NASDAQ. For the NASDAQ, what happened here about a month ago was the first time that had occurred since going all the way back here to February of 2022. So you literally had an entire year in what would be identified as a death cross environment with no head fakes along the way. So maybe it makes it even more impactful when it finally does cross up and over like it has here more recently. Whereas with the S&P 500 and the Dow Jones, you had a little bit more whipsaw head fakes along the way there. So a little bit of a different price action. But perhaps you would look at the NASDAQ and say, yeah, that means it has more upside because it can play catch up a little bit more, right? The NASDAQ stocks were the ones that were widely considered way overvalued after the stimulus checks and the craziness with GameStop and the cryptocurrencies and the SPACs and all that kind of stuff, that's the environment where the NASDAQ is going to really outperform. But unfortunately, the pendulum swung way too far and became way, way, way overvalued. Well, some could argue that maybe the pendulum swung too far the opposite direction and became somewhat undervalued. I'm not sure if I would argue that, because I still look at valuations as being a little bit on the rich side, but others could argue that out there. And if that's the case, and their expectations is that AI is going to lead us into a brave new world where technology stocks deserve sky-high valuations and that we're heading back to all-time highs on the NASDAQ, well, you can see we're still somewhat further down in that trajectory, and therefore there would be upside potential if that is what your mindset is as we move forward. Russell 2000, as you can see, is the only chart that remains in that death cross territory with the orange 10-week moving average below the blue 40-week moving average. And that has been the case since the middle of March, when, coincidentally enough, that's exactly when the banking crisis hit us, right? So as soon as that happened, those small caps fell out of favor, and they've remained out of favor that entire time, whereas the large caps and the mega caps, especially the non-banks, were strong enough in that time period to push those other indices higher to have those golden crosses that have taken place there. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. And it was a week since I've done the video, since I was gone on Thursday for my road trip. So thank you for allowing me that flexibility to get away every now and again. But the last time I did the video, 107 of you stepped up and clicked like. And like I always mention, as long as we're up and over 100 likes, I'm more than happy to give you a full-length video. If we're under 100 likes, then I plan on just giving you a 15-minute version, so that gives you guys a little bit more control. Some of you may not like these hour-long videos here, and that's certainly understandable as well. So if that's the case, then don't click like. On the other hand, if you like the additional extra long-form content, including the trade application examples and the sector analysis and the 12 grid analysis and all that kind of good stuff, then you're going to want to make sure you get in the habit of clicking like there for us. It's the easiest way to support us and say thank you to us. Remember that these videos do soak up a lot of our time, and typically we're spending at least 3 hours putting together this video that we don't get paid to do. So of course we enjoy getting the word out about our organization and hopefully educating folks a little bit along the way, but the question is, do we need to do this as often as we do? And so that is something that we always debate internally, and if you want us to do them as often as possible, then we ask one very simple request out of you, and it only takes 5 seconds out of your time, doesn't cost you a single penny, and that's just simply to click like for us there on Twitter. So let's do some shout outs here. Thank you to John, thank you to Das, thank you to Brian, thank you to Trunk, and to Big Jock, and to Carl, and to Neil, and Dr. Bob, and HR, and Tim, and Tom, and Scott, and Paul, and Lucius, and Jose, and SC, and Dave, and Ayakipa, Dave, Paul, Margie, Valerie, Jorge, Eddie, Vince, Ann, Surendar, Paul, Kirk, Ray, Sheila, Linda, T-Fib, H. Patel, Dave, BZ Japan, Craig, Austin, Robert, Brandon, Business News, Phil, Ken, the list goes on and on and on. I can't get to all of you, but I do like to send out my thanks to you, because I know it takes an extra effort out of your part as well, and most people who watch these videos do not take that extra effort. So those of you that do, I really appreciate it. Please keep that up. All right, let's go ahead and now have a little chat here about the sector selector as well. David did teach his directional option strategies class today, the inaugural Zoom meetings video from our transition from WebEx. So feel free to check out that recording if you have time. And as I mentioned before, you can go to the Trading Room's calendar on May 9th, and you'll see my pre-recorded dividend growth investing class as well if you're interested in that content. But let's have a chat here about the sector selector. This is as of last weekend, so a friendly reminder, things may have changed in the last couple of days, but at least gives us a pretty good feel for any rotations that may be taking place out there. Also a reminder that this is based on an equal weighted system, so it is not market cap weighted, it's something that is using purely price data, so it does not include any fundamental information. It is driven purely by price over multiple time periods, 1 month, 3 months, 6 month, and then it is weighting the 1 month more heavily than the 6 months. So when you're scoring based upon that methodology, consumer staples is once again our leading sector. That's the second straight week that they have been up at the top. Consumer discretionary continues to be number 2, and that's also their second straight week in the number 2 position. And since we're in the mode, I will also say utilities is ranked number 4th for the second straight week. So out of our top 4, which is what we traditionally focus on in my top-down trend trading class on Monday mornings, 3 out of the 4 positions were exactly the same as the prior week. In this case, the difference is industrials replaced healthcare in that number 3 position. But I think it's probably pretty close, and I wouldn't be surprised at all to see healthcare sneak back into the top 4. I know for a while today healthcare was actually up. I noticed some of the CRISPR stocks up double-digit percentages today. They've kind of come to life here more recently, and some of the other, pharma and med tech plays were holding up okay, right? We talked about Dexcom as just one example, and then also McKesson as another example when we were looking at the heat map earlier. So we'll keep our eye on that, but I'm not counting healthcare out quite yet. I think it has a reasonable chance to get back into that top 4. Now, whether we want that collectively or not is another question, because remember, if healthcare would have replaced industrials, that would have actually been a little bit more of a defensive tone to the market. So it's actually a good thing in this case that the industrials, which are a more cyclical sector, replaced a more defensive sector like healthcare. Now, it didn't completely flush the defensives out of the top 4. We still have staples at number 1 and utilities at number 4, but that simple, replacement there, our swap in that 3-5 position, was slightly healthier for the market, all else being equal. Of course, consumer discretionary is more cyclical and growth-oriented, so the market does enjoy seeing it in the top 4 like it has been here more recently. In terms of what we saw, in the middle of the rankings, not a whole lot of movement, quite frankly. I did notice that technology finally stopped its slide. Remember, technology was number 1 for 5 weeks in a row, and then it started that slide. Well, finally we got a slight improvement from number 8 up to number ranking 7, so a little bit better in that regard. And that may have been as a result of Apple having a pretty nice earnings announcement last week. Now, as I mentioned before, this is not market cap weighted, so Apple has the same impact as the other tech stocks. So I don't want you to misinterpret that statement there. But remember, Apple oftentimes acts as a bit of a bellwether to the technology sector. And when Apple goes up, many of the components manufacturers that go into an iPhone will also go up with it. Now, today that wasn't the case. I noticed that Skyworks Solutions was down. It did recover from the lows on its open here today. But Skyworks is one of those companies that if you busted a iPhone open, you would find components from Skyworks in there. But that was today, right? And this is put together as of Friday night, so we wouldn't have had that information yet. So last week, you probably had some good vibrations going into more of your mid-cap tech stocks because of what happened to Apple with their really strong response to their earnings announcement. You will see at the bottom, financials dead last yet again. How many weeks in a row is this? 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row. The financials have been dead last. They just cannot get out of their own way on a relative basis, right? It's not like they've always continued to plunge. It's just that even in the up weeks for the rest of the market, the financials might just go up a little bit. And so they're just not gaining any progress on a relative basis there. And by the way, energy is in the second to last position for the third straight week. Our trade application example later on will actually come from that energy sector there. So that's your sector rotation information for the week. Let's go ahead and now pop back on over here to the main part of the platform, and let's do some 12 grid analysis. So let's go ahead and start off with chart 5A. This will be our asset class 12 grid. And as you can see here, it's a bit of a mixed bag depending upon where your eyes are focused. But as is often the case, we'll start our conversations in the lower two corners because that seems to be driving a lot of activity here within the last year or so. So in the lower right-hand corner, we have the 10-year U.S. Treasury yield. And today was a rare day where it didn't do a darn thing. You can see it was completely flat, according to what I see right here. It moved 0.00%, and I can verify that here. I've showed you guys this in the past as well, but I'll show it to you again because it happens so rarely. If I maximize this cell, it's hard to see against the green background, but this color of that is kind of on the outside of the candle right here that I'm kind of circling is gray. And anytime it's gray, it means that there was no movement. It was literally flat. So it doesn't mean that it was flat the whole day. It had movement on an intraday basis, but by the time it closed, it exactly matched the previous day's close. So that doesn't happen very often. In fact, on this particular chart, I only see one other candle, and that was one that happened exactly 3 months ago. That was also gray that particular day back here on February 9th. So its closing price was exactly the same as the day before that. But all of these other candles are outlined in either black or red, and of course that would tell you whether they were up or down that particular day. So a little bit of a rarity there in the Treasury yield market with an exactly flat close, and the 10-year Treasury yield is currently 3.52%. On the other side of the coin, on the other side of the bottom rung, in that bottom left-hand corner, you see the US dollar. It was not flat today. In fact, it had a reasonably strong day. Remember, currencies traditionally don't move a lot, especially the US dollar, which is the most liquid currency out there, and especially in this format where we're using UUP as our proxy, because remember, this is not just the US dollar versus one other currency. This is the US dollar versus a basket of currencies. So you typically are not going to see massive movements there, but this was a reasonably strong day, 0.32% to the upside. Let me right-click on this and maximize this as well. And you can see here that it was an important day in the fact that we are now back above the 30-day moving average. Now, the 30-day moving average continues to fall, so that's why we have this yellow color here. In this case, price is above a falling moving average, so you have kind of conflicting signs there. But it's at least a start, right? We had another attempt at that over here. Again, notice that color of the moving average changing to yellow automatically because price closed above the falling moving average that day. It actually did so the next day as well, despite the sell-off from the open that day. But the very next day after that, it fell back below that moving average, which is why the moving average color changed back to red. So let's see if we can keep it above the moving average this time in order to see if this weekly bullish posture has any strength to it, any gas in the tank, so to speak. Because right now we would still identify it as weekly bullish because that line is at 41 and rising. Remember, again, it's got to get above 50 and rising before that would change from a light green background color to a dark green background color. So it could do it. You can see it's been kind of hanging out here in just under the chart's midpoint for really the last week and a half or so. So it wouldn't be unheard of if it could get up and do it, but it would probably need to see the UUP get up here to approximately these candles, the tops of these two candles over here, and ideally hold them in order to then flip that to a strongly bullish intermediate posture. Now, again, I'm not cheerleading that personally. I actually prefer it when the US dollar is weak. I find it to be a lot easier to make money in the stock market when the US dollar is weak. So this is not necessarily something I want to see, but just, don't kill the messenger. I'm just reporting what I see. And that could be another reason why we saw some struggling in the equity markets today, because the US dollar got a little bit stronger there. Now, despite that, we had a little bit of an oddball day in that both gold and oil rose today. Remember, that usually does not happen. Typically, when the dollar is strong, at least one of those two commodities is weak. But today, that was not the case. Both of them had an outperforming day. They both outperformed not only the US dollar, but of course the US stock market as well. Gold remains in quite the nice upward trajectory there. For those of you that are part of our premium organization at Market Scholars with our premium packages, will know that we actually placed a bullish swing trade on Newmont Mining on Wednesday morning in my factor-based swing trading class, and it was one of those where we got to hit the old easy button because we were able to get out of that trade approximately a day later as Newmont ripped higher. So we've had a few of those lately. Sometimes you get lucky in that regard, right? You plan on being in a swing trade for 3 weeks. Instead, you get out within a day. And as I was telling my students that day, that Wednesday morning last week, I was really impressed with gold's bounce that we had been seeing there. And I'm still impressed. Now, is it quite as good today as, I was looking at it last week? Probably not quite as good. That was a pretty big pullback that gold ended up having there, it looks like, on Friday. So that's another thing where it's good to be nimble, because we got out of our Newmont mining trade on Thursday before gold dropped the very next day. And it might not have been quite as easy for us to lock in max gain profits in that situation where gold would have underperformed there on Friday. So that's another nice benefit out of swing trading, right? Every strategy is going to have its pros and cons. We teach 8 different trading rooms here at Market Scholars, but I always tell my swing traders that's one of the edges they have. That agility to get in and out will sometimes really benefit you, whether you know so at that exact moment in time or not. But anyway, I still like the way that gold looks. It's still bouncing very nicely right here. It's just that it's unfortunate that it had to break that really strong 3-day push that it had last week. So you're trying to get back up there, and as you can see, the background color remains dark green, telling us we still have a strongly bullish posture on gold. We still have a green 30-day moving average. Price is above the rising moving average, and we're very close to 3-month highs. In fact, as I was mentioning to the students last week, it would not surprise me in the least if gold hits an all-time high this year. I could be wrong about that, but we're not that far away. It just has to have the right types of conditions, and we could be talking about gold at all-time highs here. So there is a lot of strength in the shiny metal at the moment. Oil has not been that strong, but again, it was up today. Gold was up 0.71%. Oil was up 0.95% today. But you can see oil had a really terrible stretch of things here. Remember when we were looking at the sector selector here a moment ago, and I was mentioning how energy stocks had been second to last for 3 weeks in a row. This is the reason, right? When you see oil go from right here down to here during that 3-week period, that should remind you why oil stocks were also struggling during that time period. But maybe there's a little bit of a ray of sunshine here, because for the last 4 trading days, oil has actually been up. Now, we're still below the moving average, so I don't want to make too much of it, but, at least we were able to protect that prior low point on oil back here in mid-March, right? You had a pretty nasty rollover, and you had this reversal take place before breaching those prior lows. So maybe this is just destined to chop sideways for a bit of time here and not really get too directional to the upside or to the downside with the oil assets. So at the moment, with a 0.95% move higher in oil today, we now have that weekly bullish posture, so obviously a lighter green color compared to the dark green on gold. So gold still looks like the stronger chart, but there is some signs of resilience out of oil here all of a sudden. However, you do still have conflict, so to speak, with that moving average. Yellow, in this case, prices below a rising moving average. If it can get up and over there, then maybe we can start having the conversation about getting a little bit more directional bullishly. But until then, you probably better tread cautiously around the oil-related investments and themes that are out there. In terms of our bond markets here today, looks like they were pretty much down across the board. TLT was down 0.36% today. It remains with a strongly bearish posture. Remember, I got to keep my eye on this one because I do have an iron condor going on TLT for the paper money account here. So remember, anytime I make any sort of management decisions with the trades that we do for our trade application examples in these videos, I'll let all of our premium members know via Telegram, what I'm doing. If I need to close those down early, or if I'm, taking max gain or max loss or different things like that. How we keep you guys updated is through our Telegram alerts channel. So that's another benefit of being a 3-year premium member at Market Scholars. In the foreign bond category, you were also down today, but not by much. It was only down 0.06%. You do have the red moving average, similar to TLT, but notice that foreign bonds are holding up much better. The background color is light pink, so we have a weakly bearish posture versus that strongly bearish over on TLT. So it seems like foreign bonds a little bit stronger at the moment than U.S. bonds. High yield bonds also struggled today, but not as much as government bonds. Part of the reason behind that might be because oil prices were up today. Sometimes you have a little bit of an offsetting effect because there are a lot of junk bond companies that have raised money in those high yield markets that are in the oil patch because many of them were on the brink a few years ago. So sometimes you get a slight benefit on an outperforming oil day that you see within the high yield bond index. Now, I don't want to make too much of it because it was still down today, but sometimes people would say when you have a risk off day like we had today where the S&P 500 was clearly down, there was more selling than buying, that would be a day that if you're judging risk appetite, you would assume that junk bonds and corporate bonds would be doing worse than government bonds. That did not happen today. They were both down, but government bonds were down worse. And that might be a little bit of offsetting effect out of rising oil prices here today. Bitcoin was basically flat today, but since I was last with you, there has been a little bit of a temperature change. That was one thing I was a little bit surprised by. I didn't hear any questions about Bitcoin at the Berkshire Hathaway event this weekend. For the last several years, there's been at least one question there, and I think a lot of people like to ask Charlie and Warren that just because they want to have clickbait, because asking a couple of 90-plus-year-olds their opinion on cryptocurrencies is sure to get quite the dramatic response, but why their opinion should matter to somebody who cares about cryptocurrencies, which is usually a younger type of a person, I'm not really sure why that's the case. Nonetheless, they usually get asked that question. They didn't get asked that question this year. They had plenty of other things to talk about with the banking crisis and everything else going on, I suppose. But anyway, Bitcoin has been on a pretty tremendous run so far on a year-to-date basis. However, in the last couple of days, things have started to get a little shaky in that regard. You can see we're back below the moving average by a considerable degree. In fact, this is probably the furthest below that 30-day moving average it's been since it had that epic reversal back here right before the banking crisis. So we got to keep our eye on that because this one's been up a lot on a year-to-date basis. Sometimes what goes up the fastest can also go down the fastest to give back those gains. So things are looking a bit shakier here in Bitcoin. All of a sudden, you do have a strongly bearish intermediate posture here at the moment as Bitcoin appears to be struggling to get up and through 30,000 in any sort of a considerable way. It's flirted with it here and there, but right now it's just a hair below 28,000. In terms of our foreign stock markets, you can see that foreign developed stocks were down 0.41% today, so they slightly outperformed the U.S. market. They were pretty much neck and neck, but you can see that EFA continues to have that dark green background. So it's another way of saying that foreign stocks are outperforming U.S. stocks at this moment. That could change, by the way. Remember, if the U.S. dollar starts to perk up, then the slight advantage currency-wise that the foreign stocks get over U.S. stocks may disappear. So remember, foreign stocks have been outperforming here in the last couple of months because the U.S. dollar has been underperforming. But now with the U.S. dollar back above the moving average, if it makes a further push higher, then we could start seeing those foreign markets start to give way some of that performance back to the U.S. stocks. We'll see. But both EFA and EEM, which tracks the emerging foreign stocks, both have that dark green background color for the time being. EEM does not look nearly as strong as EFA. As you can see, price is basically sitting right at its 30-day moving average and nowhere near its 3-month high, whereas EFA, I mean, heck, that was at a 3-month high just yesterday. So EFA kind of looks a little bit more like I was saying with the NASDAQ here recently, whereas EEM is looking a little bit more like the Russell 2000, right? It's stabilizing, it's just not like pushing to new multi-month highs. So anyway, right now it does seem like if you're looking for strength out there, Europe, Japan, Australia are some strong places. Remember, that is an area that Buffett has been talking about quite a bit, is Japan. He owns 5 of the largest trading houses over there and has done quite well with that investment and has talked it up even more so recently as saying it's an interesting market valuation wise. So, maybe that's another area where you can start looking for, some setups for your trades as well. Let's go ahead and take a look at our Sector 12 grid now. This will be chart 5C for those of you following along at home. And again, it's kind of a mixed bag here where you do have a smattering of green and pink charts. Let's maybe talk about the green charts first. Technology still looks very strong. Now, keep in mind, out of all of these charts here, I would say that staples and technology look the strongest. And you'll recall from the sector selector that staples was up there near the top, but technology was more in the middle of the rankings. And this again kind of proves that point that I was mentioning before. XLK right here is a market cap weighted technology sector ETF. It's not equal weighted. So this is going to have more of an impact from Apple and Microsoft. So when they're doing better, then it's going to make this ETF look better, all else being equal. Whereas when you're looking at the equal weighted ones, so like we have another chart here, it's this 1G right here, the equal weighted sectors 12 grid. And notice when we pull this up here, that the technology chart in the upper right, notice how it's not even above its moving average, right? It's kind of in the middle of its 3-month range, which again shows why it's kind of in the middle of the sector selector rankings as well. So the average technology stock is not doing particularly well. But what is doing particularly well right now is Apple and Microsoft and NVIDIA. And since those are the biggest market caps, then it's going to allow the market cap weighted sector ETF like XLK to look the way it does. Notice it's well above its rising moving average and very close to multi-month highs, as opposed to the equal weighted technology one, which is well below the moving average and just in the middle of its 3-month range. So there is some pretty considerable differences between the mega cap techs and your traditional kind of mid cap techs that are out there right now. But it is true that XLK and XLP from Staples do have some pretty good looking charts at the moment. The other 2 green charts are discretionary and real estate, and they look okay. They don't look as strong as technology and staples, but you can see that they're at least vying for the potential bounce that could take place, right? Sitting right around their moving averages, and the moving averages are bent higher. Whereas some of these other areas, you're just not seeing that. For instance, materials does not look particularly good right now, as it is pushing down and away from its moving average. Same thing could be said for energy right here, where it is the only dark pink chart on the board with a strongly bearish posture. So those are clearly below their moving averages. You can also see financials is below its moving average here. So there's still work to do in a number of those areas in the market. But if you're looking for strength out there, I would say that mega cap tech still has it, and also the typical consumer staples company has it. Not all consumer staples companies have it, but the average one does. All right, let's now get into our trade application example, and we are going to focus on the energy area. And you might be thinking to yourself, well, he must be talking about a bearish trade since XLE looks the way that it does. But I will remind you, even XLE is not at the bottom of its 3-month range right now. It's kind of in the middle. It's probably in the lower half, but it is not like breaking to new lows or anything like that. So what I'm going to do today, as those of you that are on our Telegram app are already aware, since I already sent out the trade details when the market was open, I'm going to do an iron condor on an energy related company, and that company is ConocoPhillips, ticker symbol COP. You'll notice that Conoco has been basically traveling sideways for the better part of the last 3 months or so. You'll notice that they've already reported their earnings, and so I don't have to worry about an earnings announcement disrupting the stock's chart either dramatically up or down. Now, other things could, right? Obviously, it's going to respond to oil prices and geopolitical events and, what's going on with, summer driving season and what might be happening with inflation. There's a number of things that can push an oil company around, but at least we know that one of the known events of earnings is out of the way. And you can see that the company actually responded pretty favorably to earnings after it looked like it was starting to roll over underneath that moving average. Earnings kind of bailed them out and pushed them back to the moving average. You're still a little bit below it at the moment, but not nearly as much as you were about a week ago before earnings. So what I ended up doing here, as you can probably imagine when I talk about a neutral trade, and you can see the lines on my chart, we're going to be doing an iron condor on this one. Now, in this particular case, one thing I didn't necessarily love about the iron condor on ConocoPhillips is that it had $5 between the strikes in some areas of the options chain, and then $2.50 between strikes in other areas. But on the normal monthly contracts, you were not able to do it dollars between the strikes. Remember, the smaller distance between the strikes, the more kind of optionality you have in setting up a multi-legged options order. So sometimes that can limit you, and I would say it did so to a very small degree in this case. It wasn't a big deal, but you'll notice that I have 2 blue lines drawn on the chart here. Those represent my break-evens on this trade. The top one I'm fine with because up there at 116.12 is my break-even. It's above the prior 3-month high of ConocoPhillips of 114.77. So for me to get in trouble to the upside, we would have to break to multi-month highs. On the downside, it's a little bit different. Usually, if I can help it, I want to make sure my break-even lines are on the outsides of the 3-month range. And this one, I wasn't quite able to accomplish that. You'll notice that my break-even is at 91.38. However, the 3-month low for Conoco was at $90.93. We're not that far away from it. It's only like 50 cents away, so you don't want to make too much out of it either. But in case you were wondering, normally I try not to do that. But in this case, because I didn't have dollars between the strikes, I kind of had to sit there with $5 wads. And so what I ended up doing was the June monthly contracts. And on the call side of the equation, so remember that's the top side here, I ended up selling the 115 call and buying the 120 call. On the downside, where we have our put spread, I sold the 92.50 put, and I bought the 87.50 put. Okay, so again, keeping them as $5 wide. On the put spread, you could have done $2.50, but the problem is you couldn't do $2.50 on the call spread. So I wanted to kind of keep it equal from that perspective. So a little bit of an oddball one there, not with a normal strike, I guess you would say, because it's not on the dollar. It's kind of a 50-cent one, so it might not have as much, liquidity and things like that, but is still doable for what I'm trying to accomplish, which is take advantage of a neutral chart that seems to be just going nowhere, and you're pretty close to the midpoint of that 3-month range as it stands. So right now I've got a little bit more cushion to the upside. So if I wanted this to go one direction, I'd prefer it to go up a little bit because I got a little bit more cushion up there. I don't necessarily want this thing to roll over hard here in the short term. Remember, you do have a dividend coming up. So on a paper money account, that's going to push the stock's price down another 51 cents. It's not a huge deal there, but can sometimes impact your thinking on it. So as always, this may not be the perfect trade for you as an individual. It is just merely an example using some of our charts and things to come up with different trade ideas for our broad audience here. So we'll see how this one goes. A neutral trade here, an iron condor on ConocoPhillips, where I don't want it to go above 116.12 on the upside, and I don't want it to go below 91.38 on the downside between now and expiration day there in the middle of June. Okay, so that's what I had for you there. Hopefully you enjoyed the presentation here tonight, getting kind of back in the saddle, so to speak, after missing it last Thursday. But if you want to help support these presentations, as we always say, the easiest thing you can do to do that is just click like for us there on Twitter. It'll be pinned to the top of my timeline. You can also find the tweet in question for those of you that watch this video on the Market Scholars website in the Twitter widget directly below the video. For those of you that are watching this directly on YouTube, you'll find the tweet in question in the description area of tonight's video. And for those of you that are on our email distribution list, you can also click the Twitter icon you see at the bottom of the email, and that'll take you to the tweet in question as well. So whatever those 4 different ways you choose, they will all get you back in the same direction there, and we do appreciate your help with that. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.